Our story begins in 2014, after the largest financial crisis the world had ever experienced since the crash of 1929. Since then, we've made it our mission to democratize the very best financial intelligence. We broke the story of Bitcoin in 2014 before the general public even knew what it was. We've made award-winning documentaries and series about some of the most important economic and geopolitical events of our time that have amassed millions of views across platforms. And we've spoken with investing legends about trends years before they played out. Here at Real Vision, we don't follow the news, we make the news. This week on social media, we'll be showcasing some of the most important pieces in our history, unlocking some of them for you to watch for free, and sharing important takeaways from them that will be useful for you in today's markets. So be sure to tune in. We also have a very special offer just for you guys. To learn more, simply click on the link in the description or scan the QR code.
Is this a trampoline landing for the U.S.? Hi, everyone. Welcome to this extended Real Vision Daily Briefing. With me today is Vincent Deluard, Director of Global Macro Strategy at StoneX. Hi, Vincent. It's great to see you again.
Happy to be here and very happy that you use my trampoline landing moniker. I'm trying to get that to trend on Twitter and, every bit helps. Thank you.
We're going to do our part. That's exactly why we chose it. And we're going to explain that for folks in just a minute. But just a reminder before we dive in, the second half of the show, today's extended. So we're going to go for an hour. We have so much to talk about, but the second half is exclusively for Real Vision members. So if you want to stay with us the whole time and you're watching on YouTube or listening in, go ahead and scan the QR code and jump on some of the incredible trials that we have right now so that you can do that. We want you to stay for the whole thing. So Vincent, the concept of a trampoline economic landing is something that you came up with and you've been writing about it. What do you mean by that? And why do you think that best describes what's happening in the U.S. economy right now?
In terms of meaning, I think it's kind of self-explanatory, right? I mean, you jump on the trampoline and instead of continuing your downward momentum, you bounce back. And yeah, that's how the best way I could describe the economy. I mean, a year ago, you had all the serious economists and the banks, kind of out recessioning each other out, and the recession is going to hit, and the commercial real estate and the regional banking crisis, and kind of all these doomsday call. And then, we saw it, well, maybe it's not going to be a hard landing, maybe it's just going to be a soft landing, and then a no landing. And today we have, Atlanta Fed GDP now cast at 4%. If I'm not mistaken, that's more than last quarter. So it is a trampoline landing. The recession that, all these supposedly informed people expected turned out to be an economic reacceleration. And I would argue that it was entirely predictable if you paid attention to the right data in the right way.
Yeah, and certainly over the last couple of weeks here, a lot of people have been talking about some of the fiscal stimulus and the fiscal side that most people just seem to either have forgotten about, or they weren't sure how effective it was, or it seemed to have sort of fallen off the radar, but it's been making its way through the system. And I think you also think this has a lot to do with the momentum, correct?
Yes. I mean, you kind of have to go back to Keynes and Econ 101 and the power of fiscal spending. I think we've been a bit insulated from that. Maybe for 40 years, we spent our time focusing on central banks and thinking that central bankers were gods, and thinking that, all you had to do was watch a Fed funds rate and that would tell you, or the yield curve. That's another good one, to know what the economy was going to do in 6 to 12 months. And it turns out that, when you give people money, especially people who don't have a lot of money, they spend that money. And as that money gets spent, it creates economic growth. That should not have surprised anyone before this kind of odd era that we were into. I don't know if you want me to go into the sources.
Well, I think what's interesting is, and I highly recommend reading Vincent's research because it's always spot on in terms of detail, but also kind of thinking outside the box. the things that you listed, and maybe just rattle through them. Is when you say that, like when we say fiscal, and you talk about when you give people money they'll spend, I think a lot of people were thinking about those sort of COVID payouts, the kind of
Mm.
one-off stimulative emergency measures. And since we're moving away from COVID, maybe that's why people kind of forgot about it. You pointed to things that are different
Yes.
and were part, I think, and it's interesting, and I want to hear about the staying power from that. So what are some of the things, fiscal things that you're looking at? And inflation reduction, that's part of it, that people have also now been saying, hang on a second, we're spending money on infrastructure in a way that we haven't in decades. What are the things that you're looking at?
Yeah, definitely the IRA and the CHIPS Acts are part of it, but I think most economists had that
Right.
in
I agree.
on their bingo cards. You're absolutely right about the COVID stimulus, kind of, a lot of the CARES Act stuff, the ERC was kind of dropping off the cliff. But you had a second wave that I think people did not quite understand coming from the inflation shock of 2022. You have a tremendous amount of payments in the US that are indexed on inflation. Most important of them is Social Security. I mean, you have 67 million people between retirement, disability, and survivorship. And we had the largest cost of living adjustment in 40 years. That was announced, by the way, October 13, the day the market made the low. And we announced this, I think, 8.7% cost of living increase. I mean, that's a lot. Like Social Security doles out about $1.2 trillion every year. So you're going to almost put 10% of that. That's $100 billion in people's pocket. And that these checks, they hit every month.
Right.
And
it's not like a one-off payment or bonus. That's what I think is really important about.
Yeah, and they go to people who will spend that money, right? Because your average Social Security beneficiary, is kind of working class, doesn't need to save, doesn't need to buy a house. Last year he's been squeezed a bit by inflation. So, hey, that extra, $100 he gets every month, that goes straight into the economy. The exact opposite of what you see, for 10 years, we try to stimulate the economy by giving more money to Jeff Bezos with the wealth effect. That doesn't work very well. But when you give money to people, that works. So COLA is one of them. And then the second, which I think
cost of living adjustment, that's the acronym that you'll hear. Cost of living adjustment is referred to as COLA.
Yes. And the second that a lot of people missed was the adjustment to the income tax brackets. And this is very much the same idea. So that's to avoid something that's called bracket creep. So when you have high inflation, basically the value of everything goes up, like price, wages. So if you wouldn't move the tax bracket, you would fall out, you'd pay more in taxes, right? Because 150,000 is now 200,000, so you're in the highest bracket. So what the IRS does is that every year, also in October, same time, based on the observed inflation, it's like, okay, I'm going to raise my brackets for next year. So October 18, the IRS came out and said, okay, we're going to raise it by about 7.1%. And that applied in January 2023. So pretty much everybody who's not in the highest bracket, because the highest bracket doesn't have a top, effectively got a 7% tax rebate. This is money that we American taxpayers used to send to the Treasury every 2-week pay period, and we don't have to do that. So you have all your 67 million retirees plus all the Americans who are working, who are enjoying almost double-digit growth in their nominal income. At the same time, inflation is falling, right? I mean, I think it's going to come back, and maybe we'll get to that later, but effectively it went from 9% to 3% inflation. But the adjustment for this year was based off last year's inflation. So there was kind of lag effect between when the inflation hit and when the compensation for the inflation hit. And I think this is where a lot of the stimulus came. And then after that, you're absolutely right to mention the IRA, the CHIPS Act. The thing about this big, I can't remember the number was something absurd, like 370 billion for the IRA, right? I mean, at the end of the day, it's just like throwing a couple extra hundred, just for show. But you can't spend 370 billion in like that's physically not possible, right? So you have to spread it over time. Given the way public policy works, there's long and variable lags for fiscal policy as well. So a lot of that spending starts to hit, it's voted in 2022, but it starts to hit in 2023. The CHIPS Act, you can certainly see it. I mean, all the fabs being built all across the country, right? I mean, in Texas, in Ohio, and these are huge projects, like $20, $30 billion projects. So you have all these sources of stimulus sitting at the same time. And again, this is direct spending. This is not, like QE where, you replace, long-term bonds with short-term bonds or short-term bonds with bond reserves where you're actually just swapping two
financial engineering at the
Yes.
margin. Yeah.
No, this is good old, dig a hole and, pay people to dig it and at night refill them. I mean, this is Keynesian stuff. And when you do this in an economy that's already running at potential, where people still want to spend them, you'll get some impulse out of this.
Yeah, I think that's really important because everyone's sort of saying like, how did everybody seem to miss this? Because the calls for recession have been so persistent, so steady, and it was really characterized as, okay, well, we just don't know the lag from the Fed policy when those rate hikes will hit. It's just delayed. There have been offsets, but now you're hearing more and more, and that helps me understand maybe why people miss this and why they seem so surprised that we haven't seen more of a slowdown or more of a recession. And just a couple comments from the audience who's listening, and Jonathan pointing out construction stocks are close to all-time highs. Jordan saying it's pretty crazy. All those years of QE just push assets higher, but really we should have just been fixing bridges and potholes. I mean, there is that argument.
Preaching to the choir right there. I'm a fix the bridges and let the billionaires, alone.
Yeah.
It should have been obvious from the start that, the wealth effect benefits the wealthy, not, and that you get more bang for your buck fixing bridges than, buying bonds. But
absolutely,
apparently a lot of economists thought otherwise.
Yeah. So, and now the staying power of this, because this is the important point, I think, here when we're talking about that. Now, the IRA and some of that CHIPS spending, that massive number you said, it will take years and years to deploy. Right. And there's always the chance, I think we all know how Washington works, that another party or something else comes in power, deficits. Maybe people rethink that and maybe you take some of that away, or maybe you somehow figure out a way to claw some of that back. But when you're talking about this other stuff that has staying power, talking about cost of living adjustment, index inflation, hard to figure out how they're going to take away money from seniors and Social Security. So that's probably pretty sticky, right?
Well, yes and no. I mean, because really what matters is the impulse, right? It's the delta, right? So of course it's going to be, it's going to be sticky, right? I mean, retirees are the largest constituency, they will get their COLAs. But what matters is the size of this year's COLA versus last year's COLA. And keep in mind that it tracks inflation with a 1-year lag.
So it'll move with inflation, but right now it's in the economy.
I think right now the estimate for next year's COLA is around 3%. That's what the League for American Seniors estimated, came up last week with that number. So if we are what I expect, which is a rebound of inflation, and I think we see that in data tomorrow already, and then we kind of go to where I think inflation really should be, which is 4 or 5%. I think that's where it's always been. You'll actually see retirees get a net real income loss next year, as opposed to the kind of like 5% real gain that they have. Mm-hmm. Same thing for the bracket story that I was mentioning about. Same story, right? That the brackets in 2020 for your tax liability for 2023 will be based on inflation in 2023, which is going to be much lower. So it could be that if inflation reaccelerates, we'll have the bad kind of bracket creep, where you go in a higher bracket because inflation is higher than what the IRS had anticipated. So in a weird way, and I've spent, I don't know, hours on Twitter and podcasts arguing with all these recessionists this year, saying, no, this is not going to happen. You guys have it wrong. And I've always been kind of the lone bull on the economy. I suspect that I'm going to be more bearish on the economy than the consensus starting in January, February. Now, we'll get into 2024 with a lot of momentum, I think. But that momentum is going to slow. It's going to hit the brakes. And it could be that, just at the time when the quote unquote smart guys finally get it, the economy actually slows because I'm not questioning the fact that, raising the Fed funds rate from 0 to 5.5% in 15 months. I mean, yeah, at some point that's going to take a bite. Now, I will say, and maybe you can go into it later, but there has been a weird stimulative effect at the beginning of these higher rates through the Fed's balance sheet, effectively. But again, the delta was enormous this year because we went from zero, the Fed paid nothing on its liabilities until the first hike in March of 2022, to now they pay 5.3%. They have like 5 trillion in bank reserves and a reverse repo facility. So 5 trillion times 5%, that's 250 billion. That the Fed is just writing checks to people. I mean, this is, this would be, this is the GDP of a medium-sized country, that the Fed is just literally at the end of the month, just crediting every bank balance with that money. So that was hugely stimulative this year because we went from zero. Next year, if we have the rate cuts that the market seems to price in, that impulse is going to be negative as well.
Yeah. Okay. I want to put a pin in that because I want to come right back to that. But just very near term, both Colin and Christopher are asking, what do you expect for tomorrow's CPI? Do you think it's going to be in line? Do you think it's going to be weaker or hotter than consensus? This is very short term right now, right? So there's.
I mean, making this kind of short-term forecast is the best way to look like a fool, and I will volunteer. And please, please keep in mind that I'm taking the hit here, so I'm gonna say it's gonna be hotter. I think consensus is for 0.2% month over month and 3-ish year over year. I have a model that just looks at base effect and energy, and it's probably going to be closer to 0.3, 0.4 month over month, and then a reacceleration like 3.3, 3.4 year over year. I'd have to run the exact numbers, but basically the intuition is pretty simple, right? I mean, base effect have peaked, right? So June 2022 was the peak, and then actually on a sequential basis, July 2022 was lower. Like this was the actual month over month drop. So we went from very negative base effect to very positive as far as inflation goes. To commodity prices. I mean, with this, gasoline prices are very high. I mean, I live in California, I about 5 everywhere, and that's a big short-term driver of inflation. And then third is the weakness of the dollar that probably will lead to some important inflation. So all in, I think we see a little bit of an upside surprise. I'm not sure that the market will entirely freak out because everything that I've kind of explained, I think eventually even the Wall Street economists will be able to understand that. And then it's base effect, but so I think we surprised to the upside. I don't think, unless it's a huge upside.
Yeah, it's not crazy though. Like a surprise to the upside, but within reason of what people are thinking about.
Yeah, I think for now, like we still kind of have this narrative of the soft landing, and that's kind of dominant, and I think we can withstand maybe one more month, but my view is that after that it keeps going, and then that's kind of when we have the problem maybe in the fall.
So this was my next question. So what is your outlook if we move just past the immediacy of this week's numbers? What is your outlook for inflation? So we've got all this momentum in the economy, and I'm holding the thought that you're going to get bearish next year. We'll get into that, but we've got all this momentum in the economy. What happens? What does that mean for inflation? It sounds like it would stand to reason that inflation is going to be problematic and we're going to see a resurgence because we've got all the strength in the economy, right?
Yeah. I mean, that's in a way, my view about inflation is that we've reset at 4-5%. And we've been there. If you look at like the super core, the sticky, the trim mean stuff, it's been there for about a year. Like the spike to 9% was not very real, right? It was the oil shock, the Russia invasion, the used car, the plane tickets. And then that took us down as well, right? But in reality, maybe it was 6% last summer. Now it's around 4.5. And then that is my view that, we will reset there. That is actually a good thing for the inflation target. So I think that's where we want to go. In terms of factors that I would stress, so other than the short-term stuff we talked about, the base effect and the energy prices, one area that I think people don't look at enough is healthcare. So according to the BLS, the price of healthcare in the US has declined for 9 straight months, and is now cheaper to get cured in the US than it was last year. So we have a deflation in healthcare.
Sure as hell doesn't feel like that.
I know my premium went up by 15% this year. I had my insurance. And I actually checked, maybe I'm just unlucky, but no, I went to the ACA website, all the guys, the Obamacare that offer plans, did up by a median 11% this year. And it makes sense, right? I mean, the cost of everything has gone up tremendously. Like, how could healthcare, which is mostly labor, how could that go down? I mean, we have these shortages of nurses, of doctors, obviously the big pharmaceutical always know how to make money. I mean, healthcare and inflation is usually higher. Like, how could that be that it's lower? And it's the same kind of mechanic as in shelter. Like all the deflationists right now, they love to point to shelter and owner's equivalent rent, and it resets every year, so it's lagging and blah 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 blah. Okay, fine. I can do that too, but look at how the BLS looks at healthcare inflation. You'll see the exact same dynamic. Annual resetting of prices, because a lot of that negotiated rate. And then instead of measuring the actual cost, it's imputed from the profits of insurance companies, which have been completely skewed over by COVID, because for a year, no one went to the doctor because we were scared to have COVID. So we had this massive distortion that have created this artificial deflation in the healthcare CPI, and that's 10% of the index. So if you have 10% of the index in deflation, if we go back to, let's say, 5%, that's 50 basis points added to the CPI. If we get that, there is no way we can get to 2% on a sustained basis.
So, okay. So I want to bring up a clip here because this is along the lines of what we've been talking about all week. Tony Greer sat down with Kevin Muir this week and had a great conversation about all of these topics. And Kevin expressed concern that the market psychology is too anchored in the past. Let's have a listen to a clip from that, and then we'll talk on the other side.
I just want to contrast this and think about it in terms of 1982, when Volcker came and he broke the back of inflation. Nobody wanted to own bonds. And the reason they didn't want to own bonds was because they were convinced inflation was coming back. And because they were convinced inflation was coming back, they kept the real rate, meaning the rate of bonds over inflation, extremely high for a long, long time. So you could earn positive real rates by buying the bond market because everyone thought it was coming back. Okay, it took many, many years for that kind of persistent real rate to decline. I think we have just the opposite right now, Tony. I think that people continually underestimate how persistent inflation will be. And I think that that's why we're seeing people rush into the bond market, back to the sentiment talking that we spoke about. They keep rushing back in there, and they keep remembering the old era when rates went to 1% or 0%, and how much money they made that way. So we are going to have persistent kind of over optimism about bonds. And if you can't just be short bonds. It doesn't quite work that well. What you want to be is long inflation.
And that full conversation is available on our website. If you are not a member, you know what to do. Scan the QR code, or Brian has put a bunch of info in the chat for you. So, Vincent, are investors too quick to assume that we're going to revert back to a low inflation environment?
Yeah, first off, great clip with Kevin. I mean, fantastic guy. I mean, he's been in that higher for longer, the economy is stronger than you think camp at a time when it was not cool. So
kindred soul.
Yes.
You've been suffering together.
He's also the nicest person. So I'm very happy. And then of course I'm going to agree with what he says. I mean, he gets it right. I mean, we drive looking in the rearview mirror, right? In the early 80s, people were traumatized by inflation, and they kept interest rates real rates too high for too long, and we were doing the exact opposite. I mean,
yeah, and it's interesting to bring it up, I think, because that part's about not just the data, but the psychology, how hard it is to turn that recency bias when that's all you've known. And in fact, Andreas was very honest about that when I asked him to. My colleague, we were talking about this in a recent, I don't know if it was Academy sessions and I said, what's the risk to your forecast, or what do you worry about? And he was like, listen, I've only lived, based on his age, I've only lived in an environment where we've had this low inflation, low interest rate. Could I be experiencing recency bias myself? Sure. So I think everyone has to check. That's an interesting angle to think about.
Yeah. And again, I mean, I was just thinking as Kev was talking about these cycles of inflation. So he mentioned 82, right? So it's 42 years since 82, right? Then you add on, you subtract another 42, that gets you to 1940. That was the bottom for yields, the prior one. It's amazing that, these very long cycles when it comes to rates and inflation, that back then, we're just coming out of the Great Depression. It was obvious that inflation is going to pick up. We had a world war, for God's sake. Like the entire world was throwing bombs at each other. And yet bond yields are ridiculously low. And then after World War II, they start going up for 42 years and then down for another 42. I mean, it's funny how sometimes history rhymes. Like I think we are at the dawn of one of these very long-term cycles. And at each one of these turning points, most investors get it wrong because, as Andreas mentioned, all that they've known is the old world. It was inconceivable for someone in 82 that inflation would fall to 2% on its own, that would have negative yielding debt. I think in the same way now, it is inconceivable for a lot of the bond market that inflation will not go back to 2%, but instead will hopefully stabilize at 5%.
I'm going to ask you about that hopefully a little bit later. But so what does this mean if inflation is going to remain elevated and we're in this reset now to something closer to 4%? What is your outlook for treasuries?
Well, I mean, I've obviously been a big bear on treasuries for a long time. I feel a bit better about them now that we repriced quite a bit. I mean, I was livid in March when we had a Silicon Valley Bank crisis, and the futures market was pricing cuts yesterday. And I think the Fed missed the mark there. I mean, it just thought that it was a second policy mistake. There was a transitory mistake, third policy mistake. There was keeping the accommodation for too long, calling inflation transitory, and then getting freaked out by what turned out to be a non-event. Anyway, so in March it was awful. Now, I look at the 2-year getting close to 5%. The front end of the curve, I still think the Fed is gonna do one more hike, and then is gonna keep the fear of another hike live. They need that for liquidity reason. They need to basically empty the RRP into the TGS. So I think that's why they need some slope up front. But I mean, we're talking like 10 basis point gap on the front end. The bond market is at least the short term market is not delusional the way it was 3 months ago. On the long end, I still think it is delusional. I think we can go to 5% very easily. I actually think we will get there, and we'll get there in a couple of days. I don't know when that's going to hit, but when it hits, it's going to be like the gilt market. You'll see, 30 basis point up 3 days in a row because of some sort of a liquidity event. So the long end, I'm bearish, and I'm especially more than rates actually is really inflation break evens that seem off to me. I think that maybe the best way to play that is with inflation swaps, because I think that's where the market is most delusional. Like the real rates have come up quite a bit, but it's the inflation expectation that seems too low to me.
That's really interesting and a little bit terrifying to think about that happening. And you think it would be some like an event that would freak them, that would spook the market?
Yeah, like I keep thinking about what happened to the Liz Truss, the latest prime minister in the UK. The market is very tense. She announces this big blowout budget, and all the pension funds. I mean, I'm sure British pension funds are not the only one with improper duration hedging and lots of hidden leverage in the system. There's never one cockroach.
Yeah.
And
this is
maybe
true. As somebody who lived in New York City can attest to, this is true.
And
but
we have,
sorry.
Yeah, we have very bad liquidity at the long end, and we have had for a long time. If you look at I think there's a Bloomberg liquidity index at the long end, it's very bad. The volatility at the long end is pretty bad too, which is an indication of lack of market depth. And I think we've been avoiding that to some extent by freezing it, right? We put all the Treasury issuance was at the front end. Basically that Yellen's been running the debt on bills, which you could argue from a taxpayer standpoint is awful, right? Because the curve is inverted, so you should be tapping that long end. The reason she's not tapping it, she prefers to pay one percentage point more, is because she knows that if he tapped it, there wouldn't be a buyer. So yeah, the liquidity is bad. The issuance is, they're gonna have to move to long end. I mean, the Treasury just announced actually that they would start, hitting the 10, 20, 30 year again. And I doubt that we'll see a lot of buyer at this duration. Also, another problem that's been freezed is the regional banks, right? So for a couple of years, we stuffed treasuries down the throats of regional banks and banks in general. Buy them, they're risk-free. You can, well. Then, of course, SVB blows up, but then we freezed it with the BTFP, like the Bank Term Funding Protection Facility, where we basically told the banks, hey, don't sell your long-term treasuries, put them at the Fed, you'll get cash par value for a year, but there's still that overhang of long-term treasuries that the banks have. So I see a lot of possible sellers, and I don't see an obvious buyer for long-term treasury debt at a time when issuance is going to spike.
Okay, that's a super important point and concept. I just want to ask you, though, before I let our YouTube audience go, I think it was Alex Morgan said, there will be no rate pivot until something breaks. So there is this concept that if you have an event like a gilt type event here, where you start seeing Treasury rates, that will be something breaking, and that the response won't just be that you get this spike in yields, but the response will be like, oh, the Fed's coming in, yields are going to fall because now we're back to cutting, and the Fed to the rescue, the Fed pivot. Do you not see that playing out that way?
A little bit, but I see it with the balance sheet, not the rates. Because I mean, if we see like the long-term yields go to 5%, cutting the Fed funds rate by 25 bips not going to do anything, right? You're going to have to start using the balance sheet, which is, by the way, what the Bank of England did. So I think the first shoe to drop will be quantitative tightening, so stopping, because this is where the liquidity problem comes from eventually. That the fact that we have not only 150 billion in deficits every month, but we have 100 billion in treasuries maturing that the Fed kind of lets roll over the balance sheet. So I think that's where it comes in. You stop that, and then maybe you do some sort of a twist or reverse twist. I don't even remember. We had so many operations at this point of like,
and they're all very creative. Exactly.
Yeah.
So
your yield curve is like a knot of like,
yeah. So they would use tools, whether existing ones or new ones they come up with on that side, as opposed to just cutting that rate. So you're not going to see it play out the way that we were used to back in the day. I think that's super interesting. All right, we're going to jump over for members. Like I said, if you want to come with us, and you should, because we've got a lot more good stuff to cover, just hit one of the links that Brian put in the chat.